Hey guys.
Hey, good morning.
Hi.
How are you doing?
Good, Ken.
Good.
You enjoying I know it's been record breaking all week in the high 70s here. Is that same up in Boston, Dean?
Yeah, we have summer in winter here today. It's 70 degrees. I was actually out in the hammock on the weekend. It was so nice.
Nice. Cynthia, what are we looking at on the West Coast?
Well, it's raining, so it's warmed up, and it's really nice. Rains over winter in Portland. It's a little balmy, a little temperate rainforesty.
Nice.
Yeah.
We got a lot to cover this week, so I'm going to skip some of the banter. So I'm going to get us started. So I want to welcome everyone to our DATIQ weekly market update. This is our update for November 11th, 2020. I'm Ken Adamo, Chief of Analytics at DAT, joined by not Ned Damon this week, but rather the sapient Cynthia O'Rourke, who's a data scientist on our team. And then, as always, holding down the fort, we have Dean Croke, who's our principal industry analyst. Welcome, guys.
Thank you.
Thanks.
So, for anyone new to the show, every week, Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, we run through interesting trends in the freight markets, share some of the data that we're keeping an eye on, and then answer your questions. So if you have any questions, please drop them in the chat or the comment section. We have diligent marketing folks who are scanning that for questions and will relay them to us, and we'll answer them at the end of the show. So I'm going to jump into some key points for the week and then turn it over to Dean for his in-depth market update. So key points this week. Dry van and reefer rates surge again. We've been talking for weeks about this M pattern that usually starts, the first leg of the upward M starts around the end of the third quarter, end of September. And then we're in that second one now. It looks like that'll roar into Christmas and then come back down after returns in January. Reefer volumes are up ahead of Thanksgiving. I think most folks want their turkeys refrigerated. We have a probable rate rally well into the holidays. So this is good, right? I think one of a sigh of relief a lot of folks breathed was that we didn't see a large collapse in rates after the end of the third quarter. And Dean's going to touch on that in a minute. And then our friend Jason Miller and one of his colleagues at Michigan State have put together the For-Hire Trucking and Capacity Index. We wanted to give that a plug. So the September volume numbers just came out, up 1% month over month and about 1% year over year. And capacity is still tight and at near record levels for their index. So I recommend checking that out if you get a chance. But with that, I'm going to turn it over to Dean and have him walk us through the market dynamics and rate update. Dean?
Yeah, thanks, Ken. Lots to get through this week. We had some interesting movement in some of the markets. Let's start with the load board activity, where we look at load board postings and truck searches. The dry van load to truck ratio increased again this week. It was up 4% to 4.97. This was driven by a 5% increase in total load posts. There was only a slight decrease in the number of trucks posting for loads, so not a lot of change in the capacity side for dry van. A lot of change in the reefer side, though, as Ken mentioned, pre-Thanksgiving volumes. Load posts in the reefer sector were the highlight last week. They were up 12%. This pushed up the load to truck ratio to 11.27. Capacity did tighten. There were 2% fewer trucks looking for loads last week, and we think that's got a lot to do with the high spot rates and higher volumes pre-Thanksgiving. We start to see higher volumes from about here on into Thanksgiving with fresh turkeys in particular. On the flatbed side, load post volumes dropped by 5%, not unexpectedly as it gets colder. The load to truck ratio dropped about 5% to 33.25, and there's definite signs the flatbed market is starting to cool off. Capacity is loosening. There were 4% more trucks looking for loads last week. So shifting over to have a look at our market condition index, as you can see in our chart, there's a lot of activity, particularly in the top left in the Pacific Northwest. The US Capitol Christmas tree began its 2,000-mile journey this week from Henderson, Colorado. We're also starting to see Christmas trees that are used in the decoration side of Christmas start to move now. They typically move 3 to 4 weeks ahead of the actual peak in tree volumes, which are used on Christmas Day. Most of these come from Oregon, DAT's home state. That's the number one state for Christmas tree production. Volumes in Oregon are up 7% week over week. Rates are up 13 cents per mile to $1.94. So moving further south on the West Coast, our two top markets in the last few weeks have been Ontario and Los Angeles. But after the big surge in Asian imports in late October, volumes in both those markets dropped 17% and 8% week over week, respectively. So volumes have dropped. A lot of that freight is moving its way around the country. Capacity is still tight, though. Interestingly, rates are up in both Ontario and Los Angeles. They're both up about 5 cents a mile to $3.07 in Los Angeles, and much higher at $3.15, excluding the fuel surcharge, out of the Ontario freight market. On the on the East Coast, Indianapolis is a beneficiary of a lot of import volume from the West Coast. So is Joliet. Volumes are up there 13% week over week in the Midwest. Capacity is still tight. Rates are up 8 cents a mile to $2.71. And the refrigerated side, starting to see a lot of our winter demand for produce come across the southern border. That's where we're having a look at the markets this week in McAllen, in the south part of Texas, where the bulk of avocados cross the border. In fact, about 95% of our avocados last week crossed through McAllen, through the far crossing. Capacity is very tight, though. Rates are up 2 cents a mile to $2.44 on flat volumes. Further west in Nogales, in the Tucson market, volumes are up 23% week over week. Rates are up 15 cents a mile to $2.44. That's a market where we see a lot of our winter produce, such as cucumbers, watermelons, and squash, come across. Further east in southeast of the country, the Atlanta market took #1 position for refrigerated outbound volume last week. That was following a 12% week over week increase. Capacity tightened. Rates are up to $2.37 a mile. And what caught my attention this week was refrigerated capacity in Joliet and Chicago were tight on volumes that were up about 22% week over week. Up around $3.20 a mile, so capacity is tight. A lot of that Joliet and Chicago volume comes from the West Coast and before it gets distributed around the East Coast. So it's good to see some volumes in the Midwest market. And wrapping up the market condition index analysis with the flatbed side, flatbed in our top 10 markets, volumes decreased by 8%, as we alluded to earlier. It's definitely a cooling. In our big markets like Portland, volumes dropped again last week by 15%. But interestingly, capacity was still tight. Rates are up significantly on higher regional volumes, but there was also a 12% decrease in volumes into Portland, which had the effect of tightening capacity and pushing up rates. In our #1 market in the Midwest, Little Rock, volumes increased by 3%. But next door in the big distribution market in Memphis, volumes dropped nearly 20%. But capacity was loose in both markets. And unlike in late October, rates were down 16 cents a mile to $2.96. Wrapping up with our year-over-year view of dry van spot rates, there was a pause. We alluded to it in last week. We weren't sure if it was a cooling off or a pause in rates. It looked like it was a pause, so there's now more upward rate pressure. Dry van spot rates increased again, shifting up a couple of cents a mile to $2.27. Rates still are up 52% year over year, and with strong reefer volumes expected right through Thanksgiving and capacity tight overall, I think we can see more upward pressure on dry van spot rates as reefer carriers take advantage of higher temp control volumes in produce and frozen food in particular. In the refrigerated sector, spot rates jumped last week 6 cents a mile to $2.48. They're now 69 cents a mile compared to the same week in 2019. And although reefer rates increased seasonally right before Thanksgiving, capacity is much tighter this year, which suggests there'll be more upwards pressure on spot rates in the next few weeks. And lastly, in flatbed, after plateauing for the last 8 weeks, flatbed spot rates dipped slightly last week. They dropped a couple of cents a mile to $2.21. And compared to the same week last year, when rates were $1.76 a mile, flatbed rates are still up 45 cents a mile this year. So that's it for this week's market update. And if you want to find out more about what's happening in freight, go to DAT/resources and download the market update. So that's it for the market update. Over to you, Cynthia, for the rate forecast.
Okay, so let me get up my notes on what to say about these models. So this is our dry van forecast that we're starting with. The blue line here is the actual market rates that are observed by DAT. Off to the right, you can see our forecast models, and we've got 4 of those. We have our flagship ratecast model. The red is our short-term model. That's extremely sensitive to recent trends. And in between, we have 2 different blended variations of the flagship ratecast model and the extremely sensitive short-term. So ratecast expects that rally in dry vans to continue. It's more optimistic in the short term than the short-term model is. Ratecast has stronger expectations for normal seasonal patterns to take shape towards the end of this period and a slight decrease in rates to occur towards the end of this period. These 2 models tend to converge. The short-term very sensitive to recent trends model and the ratecast model tend to converge to the end. So moving on to reefer. Again, 4 models here. The ratecast model is our flagship model that is in green. Yeah, green. And again, same pattern as for vans. Ratecast is more optimistic in the near term. It expects that seasonal rally to continue for reefers in the near term. That convergence between the two models, the short-term model and the ratecast model, is stronger for reefers. So by the end, it would put the rates at about the same place. And the 2 blended models are in between the flagship ratecast model and the short-term, very sensitive to recency model. Now moving on to flatbed. This is a very different pattern that we're seeing here than dry van or reefer. So for flatbed, and again, ratecast is the seasonally, incorporates a lot of seasonality model. Ratecast expects flatbed in the near term to remain a little bit low, and then over time, adopt a seasonal pattern of increasing towards the end of the forecast period. The shorter term model, and this is over the scale that we're using here, it's a little hard to see, but the short term model expects the opposite to happen, expects near in for flatbed rates to be higher and then farther out for flatbed rates to decrease. But the difference between these 2 models' predictions is really not substantial enough to be noticeable at this scale. That's it for our forecast. So moving on to Ask IQ.
Yeah, before we depart from the forecast entirely, Cynthia, the one thing that jumps out at me, well, a couple things. One, we truncated some history here to show kind of more recent. So if you notice, if the graph looks a little different, we only ran it from the start of the second quarter on. But then also, if I go to the dry van, it's still not picking up Christmas, right? On any of these models, our 35-day forecast horizon, we're inching closer. I think next week we'll have, well, I think it's 2 more weeks until we'll see Christmas in these. And that's sort of where we would expect that next spike to come, right?
Yeah.
I think, and this is also interesting, right? Last week, ratecast and short-term flipped, with ratecast becoming the bull and the short-term becoming the bear. And I think what it's really would you say that what it's really relying on is that heavy seasonality heading into Thanksgiving?
Yeah, absolutely. I think that's the big difference here between ratecast and the short-term model, is that seasonality. This is a strongly seasonal time of the year, especially for dry van and for reefer. And ratecast is going to very much expect that to repeat.
Yeah, I just pointed that out for our viewers so that they don't expect pretty much cooling off through the end of the year, because there's still some time out in the right-hand side of this chart that you don't see yet, where the other strong seasonal pressure of Christmas proper and the return season immediately following should provide some inflationary pressure on rates. So with that, anyone else have anything on forecasts before I move to our Ask IQ question? All right, so our Ask IQ question is actually a really exciting one for this week. We're going to try out some new technology. I'm going to be sharing my my screen. And this is, again, a great piece of internal banter between marketing and analytics. What's the difference between 3-day rates and 7-day rates? 4 days. But in all seriousness, those that have RateView that are watching today may have noticed the addition of 3-day rates into the product. So I'm going to hop into the product real quick and share. Bear with me for 1 second. Share what we've been working on. Here we go. All right. So this is RateView. For those familiar and that use it day in and day out. Just a level set for those maybe less familiar who aren't in here every day. We've selected van. These are spot rates, broker to carrier spot. These rates include fuel. This is some history. This is what we've seen over the past few days. And previously, this little slider here would end at 7 days. As of late last week, we've added 3 days. And what does that mean? It's a 3-day weighted average. So over the past 3 days, so today that would be Monday, Sunday, and Saturday. These are all of the contributions, the verified contributions that DAT has received from our customers that tell us about what's happening in the freight market. And I pulled here my football team, the Pittsburgh Steelers, play the Cincinnati Bengals this week. And even though it's a home game for Pittsburgh, the opposite lane's not as fun to look at. So this is Pittsburgh to Cincinnati. And I went in here and I ran it. And you can see we have a 3-day rate that populates. So over the past 3 days, the interquartile range has been 265 to 377 with a weighted average of $3.30. Previously, if you'd have logged in here, you would have only seen this rate, 7-day rate. So it'd have been 310 on this same lane. So what's cool is we can really play around with this. And let's just say pull up Los Angeles. Second, Los Angeles to Dallas. Some of our friends in the industry would have you believe that if you use their rating tool, this is $1.48 a mile, but I think most folks know better than that. And we show a rate of 327. We have 32 reports over the past 7 days on 12 companies. And you might say, wow, this is a demo about 3-day rates. This is 7-day rates. Well, in here, the application has made a trade-off. We're able to show you 3-digit zip to Dallas. If I want to get a 3-day rate, all I do is zoom out to the market level, and then I'm able to zoom down to the 3-day rate level. So now I have Los Angeles to Dallas market, and I can zoom 3-day, 7-day, 15-day. So I can play around. But if I go to 7-day and I'm really, really interested in a specific 3-digit zip code, I can go ahead and pull that and get rates more specific to that market. But as you can see, just in the last 3 days, and keep in mind, 2 of these days were weekends, weekend days. We had 68 reports from 16 companies on this lane reporting. The other cool thing, if you just want a kind of a broad swath of the market, let's just say you're logging in on a Monday or Tuesday, you're a pricing analyst for a broker, even a traffic manager for a shipper, dispatcher for a carrier. When I was even in industry, I wanted our folks to use this screen a bit more. This is the state and regional. So you can do this for spot and contract. I have it for spot. Let's do region because it's easier to see on one screen for you guys. This is all of our regions. This is all of our origin and destination regions. So you can see previously, right, we had 7-day. Most of these are filled out except some Canadian. Sorry to our friends in the north. But we should, I mean, region to region, we have very, very high coverage on a 7-day. We now have 3-day. And all of this, of course, is exportable. If you want to dump it into Excel, you just click right there. And then we also, very, very few people recognize that we actually have 1-day rates as well. Now, once you start to get down to the state level, it becomes thin. And there are just some things we can talk about in future videos about 1-day rates. There's such a strong day of week effect that a 1-day rate, if you ran it today, would tell you something about Monday, and it's now Tuesday. Someone on our team describes the 3-day rate as the Goldilocks rate, and I love that reference. It's not too firm, it's not too soft, it's not too hot, it's not too cold. It really tells you the most recent things that are happening in the market without being overly influenced by the day of week effect. And again, we can dump this out into a spreadsheet, play with it. I think state to state, region to region, both will give you 1-day, 3-day for van, flatbed, and reefer. Now, of course, our 1-day flatbed rates in full transparency are not as robust as our 1-day dry van. But again, there's not as much freight moving across all of the lanes, similar to how there are with dry van. So with that, again, if you have any questions, we're going to, we have other questions we're going to get to here, but we have saved some extra time at the end. If you have questions about this product or this launch, feel free to drop it into the chat. Feel free to reach out to your account rep, or feel free to drop us a note at askiq@dat.com, and we'll be more than happy to walk through a more in-depth explanation of 3-day rates. So with that, I'm going to stop sharing. And it looks like we have a bunch of questions. So I'm going to walk through some of these right now. So from Duran Joey, I'm sure I messed up that name, but why are rates out of California still high? And how much longer before rates start lowering again? And I think Dean's been intimately tracking that market, and I'll kick it over to him for that one.
Yeah, Ken, I think there's certainly a downward trend towards spot rates, volumes out of the West Coast, but capacity is still tight overall, so there's still upward pressure on rates, even though volumes are down substantially this week because the import volumes have started to slow down. So the answer to the question is, I think, as Ken alluded to earlier, we'll see upward pressure on rates right through to the end of the holidays, largely because capacity is tight overall, but it's also been very tight on the West Coast, where there's been a lot of volume, a lot of congestion. There's a lot of upward pressure on rates. There's a lot of upward pressure on short haul rates in particular for regional moves, let alone the longer haul rates. So it'll certainly be with us here until the new year, I think, on the West Coast in terms of the capacity tightness and upward pressure on rates.
I mean, just to add on that, so I mean, it's obviously very import balanced right now to feed the CPG beast and the e-commerce beast into the fall. We're hearing reports, widespread reports, that folks can't even get intermodal capacity to ship empties west, let alone loaded east, right? So
correct.
You're seeing a lot of what we would call like transfer capacity, or I'm sorry, transfer demand that would typically move on the rail. That can't get spots, or they're not willing to pay the surcharges, so the intermodal savings aren't there, so they put it on a truck. They ship it to Chicago, Dallas, Atlanta, etc. So there's really kind of a whole host of things. And quite frankly, if you're getting $4 to $5 a mile from LA to Dallas, for example, you could turn around, not even think about getting a backhaul, and you're still making $2.50 to $3 a mile round trip. And making out a little bit better on fuel potentially, because you're not as heavy moving back west.
It's Ken. It's $1.27 today in Rateview from
Heading
Dallas. Heading west. So that's part of the reason the capacity is tight. Also, is there's an imbalance of freight moving back into the market to reposition capacity. You've got to get that high rate to come back out. So right now there's a big spread between both directions that's driving those rates up out west. For
sure. All right. So I have another question, and I'm going to kick this one over to Cynthia as soon as I read it, because I'll be out of my depth. So Infomax Freight, how does DAT usually calculate average rate per mile? And I'll answer the first part, because the second part of the question is according to posted loads and their rate in particular lanes. So it's a popular misconception. So we absolutely never use posted rate data. We don't use data from factoring companies. We don't guess at what the rate might be based off of tender rejections. We don't use older invoice data. All of our data is submitted to us directly by shippers, carriers, and brokers. Most of the data is delivered to us within 3 days of it being picked up. And then it goes through a whole cleaning process. But I want to turn it over to Cynthia to talk about some of the finer points of RateView and why it's safe and anonymous and secure and all of that stuff.
Yeah, I mean, some of the finer points of RateView I can't speak to, because that's part of the anonymity process. We really want to protect our contributors. So we have a minimum floor of contributors part for that, like the census does. You have to have a certain number of people contributing to a census block, or it won't be reported. And that's to protect the anonymity of every individual, so that you can't triangulate out one person and know that it's, for example, Tyson. So we have a minimum floor of contributors. We have a minimum floor of the number of contributions for a similar reason. And also because as you have a minimum sample size in statistics, you get a better measure of what the real thing is. So as we move to a higher minimum sample size, we get less noise in our data, and we get closer to what the true value of that parameter in the world is. So that's two reasons that we have that minimum there. I can tell you that there's weighting to make sure that underrepresented contributors are not smothered in the noise of high contributors, and also that we do some clipping of outliers so that we don't have the means pulled in one direction or the other by a very, very high or a very, very low contribution. But other than that, it gets into some secret sauce, and I signed a bunch of papers with some lawyers, and I'm not going to talk about that.
Well, part of that was a test, so Cynthia passed. She's not going to get her old Shepherd's hook to be brought off screen. I think that's important. It's something I didn't even realize when I was in the industry, that, I think one of the fears is that, a big broker on a certain lane is moving 1,000 shipments, and then you have a handful of smaller brokers moving shipments. Are they essentially on the cutting room floor? And that's not the case, right? No one contributor can make up over a certain percentage of an impact on a lane, and that speaks to the weighting. It's frustrating at times too, right? Because we'd love to generate a rate on every single lane, every single day at the zip 5+4 level. But at that point, we'd be breaking the confidence that our customers have, and honestly not giving you a representative average, right? Because no one pays the average unless it's coincidence. All the shipments are dispersed around the average, right?
Mm-hmm. Yeah, that's why it's a measurement of a population parameter. To put it in super simple terms that everyone understands.
I'll start drooling if you get too far into the stats. Tony Sabino wants a shout out, so I'm happy to do that, Tony. Hope you're having a great day. Derek asked, typically I only see 15 and 30-day rates for my lanes. So it could be a couple of things. I'm not in sales and I've only been here a year, and our sort of product matrix is daunting enough that I don't want to waste too much time trying to understand it. You may not have those lower rates. I think that might be a possibility. On the contract side, I don't know that we get into that level of granularity. And in fact, I do know we don't zoom in as much on contract rates because they just don't change as quickly as spot rates. Or it could be a sparse lane. So if you want to shoot us a couple lanes over to Ask IQ or drop them in the comments, we can figure out. It also could be equipment driven too, right? If you want to see a flatbed lane from, I don't know, Tacoma to North Platte, we might not be able to help you very much, but at least not on a 7 or 3 day. We might have a 15 or a 30 day. We might be able to give you some insight on. I think that's all of the questions. So I had one, and we'll definitely answer more if they come in, but I had one I wanted to kind of go around the room on. You may or may not have heard, Dean and Cynthia, we had an election last week. It went under the radar. Yeah, there wasn't much news on that. I was surprised. Yeah. And it kind of got me thinking about regulatory in general as it pertains to our industry. That's touches shippers, carriers, and brokers. And I know there's just a ton of stuff on the table right now. We have a new administration that'll be coming in a few short months here. So I just wanted to, with each of our respective expertise, and maybe start with you, Dean. What are you tracking on the regulatory and governmental affairs front as it pertains to carriers?
The number one thing that I'm focusing on, and I think it's what a lot of carriers are focused on, is the infrastructure bill that didn't get through Congress in the current administration. There's a lot of hope that we will get an infrastructure bill that will help deal with a lot of our deficient bridges, address our parking problems. The challenge is, though, that there's a thought there that the incoming administration might not be as narrow focused on highways. They might be more focused on infrastructure that's non-highway related. So there might be some watering down of the spending that we were expecting to be more highway focused. So we'll have to see how that plays out. The other big thing is a rollback of some of the regulations that we've seen in recent times. We could see a rollback of the recent changes in hours of service, which wouldn't be good because we've got some really good flexibility in our hours of service regs that helps improve safety. We may see some changes, of course, with air quality and EPA regulations, which will affect the cost of equipment and the design. I know manufacturers are looking at that very closely. We just had a proposal through recently about underage drivers, as in less than 21-year-old drivers that are ex-military. That would be a great thing to help give people a career path rather than waiting till they're 21. And of course, we're anxiously watching the comment period between carriers and brokers that lasts through until November 18. Good arguments on both sides about what the pros and cons of what's being proposed in terms of increased transparency. But it is an open and free market. Rates are up nearly $1 a mile since carriers were protesting in Washington. So where that goes, I'm not sure. But they're the main things that I think carriers are watching right now.
Cool. Cynthia, you've been doing a lot of just kind of related to the work that the research you've been doing around, consumer buying habits and things like that. What do you see coming down the pike as it relates to that?
So I'm really concerned with small businesses and how much the service industry is still on its butt due to this pandemic. And that doesn't seem to be getting better in the near term, if anything worse. The service industry moves a lot of money through our economy, so a lot of people are employed in the service industry, and unless we have a second stimulus package soon, and that now seems to be delayed, and we don't have employment in this field, there aren't enough warehousing jobs to soak up these empty positions, I'm concerned about liquidity in the economy and the ability of the median American to buy things and keep things in trucks by buying them. So that's what has my eye right now.
I tend to agree. I mean, we have a lot of conversations with a lot of folks in the industry, and a lot of times those conversations want to gravitate towards the supply, the capacity side of the equation. But tight capacity can definitely be and most often is generated by an excess of demand. Quite frankly, that capacity needle doesn't fluctuate as much, at least not as wildly as demand could potentially fluctuate in. Consumer spending is something I'm keeping my eye on. I'll just wrap it up with, fossil fuels were a major talking point during this election cycle, and pretty much all of freight is subject to the outcome of legislative changes and regulatory changes in that arena, whether it be fuel surcharge, which or just buying fuel in general, which every truck driver, unless I guess you have an electric truck, you have in the front of your mind. And then also things like flatbed being highly dependent on the fracking industry in the Bakken Shale, Utica Shale, Marcellus Shales area. Those are all things that I'm watching as these things unfold, to see where those trade winds are blowing, so to speak. Mm-hmm. But we're coming right up on 10:30 here, so I'm gonna start to wrap us up. A couple things. I want to shout out to Chris Kaplis's Freightvine podcast, which you can find at dat.com/podcast. He just released an excellent one with some folks from C.H. Robinson, so I highly recommend giving that a look, or a listen, rather. There's also a really good one with Fiat Chrysler. If you really want to hear about like procurement challenges in an industry that's in the throes of it right now, I'd highly recommend checking that one out too.
There's also a Cardinal Health one a few episodes back, maybe 5 episodes back, and with the new vaccines coming down the pipeline, that's an interesting listen.
Yeah, I mean, Chris draws an audience, which is awesome. Anytime I get to spend just even talking with him, I feel, because that's an area that I need to learn more about. It's kind of the shipper procurement. Most of my experience with shippers has been through the lens of like the immediate procurement, not the long-term procurement cycle. So I think it's very valuable for folks like me in our industry that maybe have more short-term experiences with shippers to think about that as you build longer-term relationships. And, he's obviously a wealth of knowledge in this area. Wrote the book, as you would say. I would encourage you guys to go check out if you have the 3-day rates in your product. If not, reach out. This is I can't undersell this. I can't oversell this enough, rather. 3-day rates are on average 50% faster than 7-day rates, because it's not just, right? 7-day rates aren't 7 days old. It's an average over 7 days versus an average over 3 days. Our 7-day product is still the absolute flagship of our entire industry. No one else can really touch that metric, and we've dedicated time and effort to make it better, right? Even though there was no one really even close to the 7-day rate, we've put a lot of time and development effort, and you can really only do that with hundreds of billions of dollars of historical information to lean on. I mean, you can do it 2 ways. You can either violate the confidentiality and trust your customers have in you, which we would never do, or you amass a giant pile of data to give you the density that you need to achieve that. So we will be here next week at the same time. Between now and then, we will have Veterans Day. So I wanted to personally, and on behalf of DAT, say thank you to all of our veterans. We greatly appreciate you and all that you do in service to our country. And with that, I'll thank Cynthia for being our special guest. We'll have to make this a regular thing. I really appreciate the insight that you provide. Thank you for joining as well. And thank everyone for listening, and I hope you have a safe rest of your week. Bye.